I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. Distress growing in the shale patch. Some investors see opportunity, others try to avoid a falling knife. And reputational risk growing for private equity as their cash piles swell, with Washington turning its focus to the field. And we'll take a look at how WeWork's troubles are affecting the entire commercial real estate market with CBRE's Chief Executive Officer. We begin the show with Bloomberg's Rachel Adams-Heard, Sonali Basak, and Lisa Lee. Let's start with those bankruptcies, which are picking up among U.S. oil producers. Bonds of the companies have gotten absolutely pummeled. Some see this as an opportunity, others showing signs of concern.
It's been obviously a horrible sector to be in for the last year. I mean, it's really hard to find something that isn't scary.
The amount of capital available in the oil patch is disappearing. We're seeing deals in the oil patch that are dramatically better for the investor than anything we've seen in the last 10 years.
Retail and energy really lead the way in terms of the quantum of opportunities over the last 5 or 6 years, and we think that's going to continue.
Make no mistake about it, just because it's not going good as an industry. When I bought the Cowboys, they were losing $1 million a month. The industry was ostensibly going down.
Yes.
The industry does not in any way dictate the promise of the individual or company in the industry.
I think people still look at that as catching the falling knife. I'm not sure anyone thinks that we're kind of bottoming out there yet.
Do you view that as catching a falling knife?
We do today. We're not spending a lot of capital there. I think we look at that as there will be an opportunity. I don't think that opportunity is or pressure to do something right today, right now.
Rachel, for those who are diving in, what's the logic?
Well, I mean, I think right now public debt and equity markets are effectively closed to this sector, and it's a very capital-intensive industry. Investors were told quarter after quarter that free cash flow positivity was just around the corner, and for the most part, that hasn't really materialized in a meaningful way. So now you have these assets that could theoretically prove some upside value, especially if you think that things are going to get better either on the oil side or the gas side, and there's just no money left in the public space to really pursue those. So if you are Sam Zell, if you are Jerry Jones and you're seeing that, now would be the great time to come in, as long as you do believe that things are going to get better on the market side. And
Rachel, are they going into the hard assets? Are they going into the debt? How are they playing this? Do we have a sense?
It sounds like from Sam Zell's venture, what he did last time was he looked and he did what's called a drill co with California Resources. So that's basically what amounts to a joint venture. This time it sounds like he's buying up assets directly, and he's looking at the actual producing assets. So he's skirting management teams. He doesn't want to mess with overhead costs. He wants to own the assets directly.
Well, that all brings us to the cash that's behind this right now. And that is really absolutely an amazing amount what the private companies have raised, and it needs to go somewhere. Sonali, we've gotten a slew of reports over the past week over just how much cash is being added to the already high levels of dry powder. Can you give us a sense of the latest there?
So the latest is that a lot of the cash being raised, which is surprising because you have investors like Sam Zell who are going direct, a lot of cash is being raised by these private equity funds into many strategies. So what is that? That's Europe, that's Asia, it's real estate, and it's venture. Actually, you have a lot of these companies going into venture. So it is broad-based, it is across the board. You have Blackstone wanting to hit $1 trillion in assets, record amounts of fundraising in general, surpassing their 2007 highs, and then you have Apollo as well wanting to nearly double their assets in the next 5 years to $600 billion.
And it is really specific to private equity, not so much hedge funds, and perhaps a little bit to private credit, correct?
Correct. There's still money going into private credit despite some concerns about the valuations and the frothiness in the market, because guess what? You have all of these public investors that look at the public markets today and say, this is volatile. We don't know where to go here, and there's also less companies for us to invest in these days.
But there's volatility in private markets too. If it's not liquid, doesn't mean it's not volatile.
It's volatile, but presumably the volatility is a little bit less. A public market investor told me, and when I asked them if they were afraid about the illiquidity, they said that's the we feel like we've learned from the last crisis. We think we know how to play these markets this time around so that we're not losing money in a big way the next time that the markets go down.
All right. Well, with all this money brings reputational risk. The U.S. House of Representatives is holding a hearing called America for Sale, an examination of the practices of private funds.
There are far too many examples of private equity firms destroying companies, preying on hardworking Americans to maximize their profits.
Lisa, is this just a direct result of all of the funds that have been raised for private equity, or something else driving this sort of public inquiry into private equity?
Well, definitely having $1.6 trillion of assets that private equity holds matters. But what's really changed the narrative, especially in Congress, has been the retail bankruptcies led by Toys R Us. 10 of the last 14 of the biggest retail bankruptcies since 2012 were PE backed. And in Toys R Us, you saw more than 30,000 people lose their job because it wasn't a bankruptcy where the owners just changed hands. It was a liquidation. And that has brought so much focus into private equity's practices of levering up companies. And as the world is going through secular change, whether it be automation or technology or consumer preferences or globalization, when you have lots of debt onto a company, it gives them less room to maneuver.
Yeah, and meanwhile, it's not just retail, because also in a post on Medium.com, Senator Warren writing, some of the same Wall Street firms that tanked the dream of home ownership for millions of American families are now the country's biggest landlords, profiting off the destruction they caused. She was going after Blackstone and Cerberus, among others, saying that they bought up a lot of rental companies. What has been their response to this?
Well, they've said, no, we do not boost up rent, because if you look at the neighboring areas, we own a very small portion, and we charge equal rent as everyone else. So they're saying that we are actually helping, and we're taking houses that are dilapidated and need to be fixed and turning those around. But even in the congressional hearing, one of the congresswomen pointed out that when a private equity firm bought a communities sector, they raised up rent 20 to 70%. So it might not be everyone, but there's definitely a perception that private equity is really hurting the average American worker.
What's the potential consequence for private equity as an asset class that Democrats in particular are going after it as the sort of whipping boy, frankly, of the entire election cycle?
Yes. So probably this Congress, nothing will happen. They only control the House. But we have an election coming up, and that could change. But even, let's say, the Democrats don't take over the Congress and the White House, there could still be repercussions. For instance, carried interest has always been a loophole that private equity has somehow managed to get off the chopping block, and it still exists. With the narrative saying that private equity might be job destroyers instead of creators, you can see that change.
Lisa and all our reporters, thank you so much. Let's get back to distressed assets in the U.S. oil and gas patch. For more, I want to bring in Charlie Beckham. He's partner at Haynes & Boone in Houston. Charlie, your firm has done an incredible job highlighting all of the bankruptcies, with nearly 200 since the beginning of 2015. Are we almost through this bankruptcy cycle in the distressed oil and gas patch?
We are not.
Okay. So how much further do we have to go?
In 2015, when all this started, those in the bankruptcy industry thought that this could take a couple of years. And going into 2018, I thought we were in the late innings of the downturn in the bankruptcies in the E&P industry. Now, with turning the corner into 2019, I think we are actually in the second game of a double header in the early innings.
Wait, this is a huge prediction, Charlie. In other words, so far we've seen nearly $70 billion of debt involved in bankruptcies since the beginning of 2015. What do you think that the total volume could be by the time this is through?
You know, the number is actually in our statistics a little over $108 billion, and that was through September of this year. I would say that in 2019, we've seen another $15 billion go into bankruptcy, debt at risk. I think that those numbers will increase through the end of the year. We know that there are a handful of other large companies that are on the edge. So you could see, I don't know that you're going to see the numbers double because I'm not sure there's enough debt out there at risk in the E&P companies left, but you could easily see another $25 to $50 billion at risk over the next 2 years.
So, Charlie, what do you think recoveries will be like?
Depends. When you look at a bankruptcy for an E&P company, think of it as a 3-layer cake. The top layer is generally senior secured lenders who have not seen much distress or impairment in the bankruptcies through 2018. Then you have junior debt and equity at the bottom. For the most part, in almost all of the bankruptcies we've seen since 2015, equity has been wiped out. The middle layer of debt, which is junior bond debt and such as that, has converted debt to equity. And I would say probably 2/3 of that has been a debt for equity conversion, waiting to hold on until 2019 when everyone thought commodity prices would increase. Hasn't happened. And in 2019, we are seeing significant differences and impairment in that first lien debt, which I think is frightening to many of the commercial banks.
Charlie Beckham, thank you so much. Charlie Beckham, partner at Hayes and Boone. Coming up, this week's power player, Bob Sulentic, Chief Executive Officer of CBRE, the world's largest commercial real estate services and investment firm. He breaks down the fallout from WeWork.
Anytime you have something that's big like WeWork was and prominent like WeWork was and is, by the way, go through a big change like that, the owners of buildings and the occupiers that were working in the marketplace and using them are going to stop and say, okay, wait, what does this mean? We got to digest it. We got to figure it out.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now, time for Power Player, our look at some of the most notable names in private markets. Recently, I had the chance to sit down with Bob Sulentic, the Chief Executive Officer of the CBRE Group. That's the world's largest commercial real estate services and investment firm. And despite all the headlines around WeWork and talk about froth in the markets, he says commercial real estate is fundamentally healthy. Take a listen.
Occupancies across product types and around geographies are generally high. There's upward pressure on rental rates. There's not a lot of building coming online in most product types in most markets, which means there won't be overbuilding. There's capital available to acquire buildings to the extent owners of buildings want to sell them. So in general, when we talk about the fundamentals of commercial real estate, the fundamentals of commercial real estate are strong right now.
And we've seen a number of banks and investment firms move some of their staff elsewhere outside of some of the coastal regions because they are getting expensive. And I'm wondering, Goldman Sachs' merchant bank actually is buying in non-coastal areas. Do you also see that as a potential opportunity?
Well, we call that the move from gateway markets to secondary or tertiary markets. It's something that's been observable for the last few years, and what's driving that in part is the gateway markets have gotten expensive. Property in the gateway markets has gotten expensive. Labor in the gateway markets has gotten expensive. On the flip side, you're seeing technology start to move to these second-tier markets. So like Tampa, Florida, like Pittsburgh, Pennsylvania, like Denver, Colorado. You're seeing an influx of tech workers, which makes the buildings fill up, rental rates go up, and that becomes more attractive to capital. And capital can generally make slightly better, if not sometimes quite a bit better deals in those markets. That's really what you're seeing there.
Blackstone's highest conviction bet right now is warehouses. Do you agree?
Warehouses have been tremendous for some time, and they continue to be tremendous. Again, the fundamentals are strong. So the buildings are generally full. Rental rates are strong and going up. There's real interest from the e-commerce companies in using warehouses to store and then distribute their product. There's a lot of good things going on in that market, and it's not surprising to see a smart investor like Blackstone concluding that's a good place to be.
As a developer and a financer and an investor, how worried are you about WeWork and what we saw there, especially as they post a much bigger than expected loss and continue to bleed cash?
Yeah. So the WeWork story is the most famous thing going on in real estate today, certainly in the big markets around the United States and places like London. We have studied co-working very closely, and WeWorking was a co-working company. There is a fundamental thing going on in co-working that's independent of WeWork. We believe that today around 2% of the multi-tenant office space around the world is in co-working. We think over the next several years that could go to as much as 10%. What's driving that is that occupiers want a sliver of their space. Big companies want a sliver of their space in a more flexible type use, and co-working solves that problem. There's a little bit of a misperception. WeWork was doing a lot of leasing in New York and London and some other markets, but we're the biggest leasing company in the world. And over the last year, co-working in total, not just WeWork, co-working in total has made up about 4% of our leasing volume. In the last quarter, 3%. So I think that story got a little bit overtold for a bunch of reasons.
So Brookfield recently came out and said that they still are interested in malls, even though that is going against the tide somewhat. Is that also a space that you're interested in, given some of the depressed nature and the valuations there?
Yeah. We watch retail very closely. And again, I think there's a headline story that there's some merit to, but there's an underlying story that's a little different. So the fact of the matter is that about 85+% of the things that can get sold through brick and mortar are still being sold through brick and mortar today. Now, that means not 100%, right? It's come down from 100%. But there is still a real demand for brick and mortar space.
So CalSTR's Chief Investment Officer, Chris Ailman, was on this show a couple weeks back, and he said that he sees the commercial real estate market as incredibly frothy, in particular in a lot of the large cities, and he's collecting cash to sort of pounce when he sees better opportunities. Are you also seeing opportunities to build cash, to sell, to be a net seller and prepare for a downturn?
Well, we have a real estate investment management business that's raised billions of dollars this year, so we do have plenty of what we call dry powder. I also think the opportunity around office space is a little underestimated. One of the things that you've seen in our sector over the last year and a half is a tremendous amount of leasing. Part of that is from job growth, but part of that leasing is coming from companies that want to use office space to attract, retain, motivate their employee base, make that employee base more productive, and they're restructuring the way office space is designed and built.
That was my conversation with Bob Sulentic, CBRE Group Chief Executive Officer. Coming up, Kylie Jenner is keeping up with the billionaires. We dig into the deal that reflects the value of social media stars today. This is Bloomberg Money Undercover. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Time now for this week's Billionaire Beef. The American beauty group Coty has agreed to pay $600 million for a majority stake in the cosmetics brand founded by Kylie Jenner. The deal, in which Coty will acquire a 51% stake, values Jenner's Kylie Cosmetics business at about $1.2 billion. Bloomberg's Kim Bosson joins us now. Kim, I think it's a telling sort of development in retail that Instagram stars are becoming billionaires off their presence. Can you give us a sense of how important the social influencer has become for retail?
Yeah, they've had this very long relationship with fashion, beauty, retail, all these kinds of companies. If you go all the way back decades to the red carpet at the Oscars, every year you put dresses on the women and suits on the men at the red carpet, and you get that exposure, you get that fashion credibility as well. And now these celebrities can get closer to shoppers than ever before because of influence on social media.
Okay, so given the fact that a lot of private money is coming into this, private equity increasingly going into not just with social media influencers, but also sports stars with a new venture that we just reported on with the NFL and other outlets. I'm wondering, how do you know when we've reached peak influencer? How do you know what this is worth?
I think you see something like this Kylie Jenner deal. It wasn't even the biggest beauty deal of the day yesterday. Estee Lauder bought a Korean skincare brand for $1.1 billion at an enterprise value of 1.7. So, like, these are big businesses, but it's not totally reliant on that celebrity. The biggest star here in recent years has been Rihanna and her Fenty line. She has started the line Fenty with LVMH, the world's biggest luxury company, and they want that to be a true luxury fashion house, and that's what they're investing in.
All right, Bloomberg's Kim Bosson, thank you so much for being with us. Now, from investments in beauty to investments in art, on our last show, we mentioned that the semi-annual sales of high-end art at major auction houses in New York were targeting sales at the low end of the estimated range. Bloomberg's Katya Kazakina joins us now to fill us in on how the sales went. So what was it like, Katya?
So it was $1.4 billion in total, which is within the estimated range, but it's a third down from a year ago. So we really felt a lot, the demand was there, but the supply shrank. So the biggest price was for Ed Ruscha, $52 million painting. Actually, it was the first season when the estimated works did not surpass 50 million. But it sold for more, so that was a great result. But then also a lot of work sold on a single bid. So there was no real fireworks in the room as much as we kind of came to anticipate.
Were there any works that sort of exemplified the investor demand at this point?
Well, yeah, of course. So, you always have the speculators who buy at very, very low prices and then resell for a lot more. They usually chase younger emerging artists. But at the same time, it really showed how finicky the market could be because a lot of impressionist works that were purchased just 5 years ago did not sell.
Can you give us a sense of what this says about the wealthy buyers at this point? Is there sort of a sense of hesitation that you're feeling that's bleeding into the art auction market?
Right, exactly. So the hesitation was definitely on the sell side because I think that a lot of people didn't think it was the right time to part with their biggest trophies. On the demand side, I think we saw a lot of dealers buying, a lot of Asian collectors buying. And there were deals because collectors were asked to lower the reserves at which they were comfortable selling. And so people saw that delta, right, and went shopping. So it was kind of a little bit of a buyer's market. But on many lots, we saw just one bid. Even the work that we're seeing on the screen, it was a record price at the time for this very important African-American artist, Charles White. And it was highly anticipated painting, but there was one person who bought it and bid it.
Katya Kazakina, thank you so much for being with us here. It's time for this week's big number. Well, the rich aren't just getting richer, they're getting older. And fortunately for their children, they're set to leave plenty of money in the bank. This is the big number. About $36 trillion will be inherited from one generation to another over the next 30 years. That's according to a report from wealth manager United Income. That does it for us. Reminder, you can catch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 2 a.m. in Hong Kong. This is Bloomberg.